I just wiped off that entire 35 grand
what I owe the IRS.
and I still have $85,000 remaining. I've solved 5 issues here. 5 issues in 1 move.
The property almost doubled. If I was explaining it to a fifth grader, you're buying something that you can make money from it.
Your tenants are paying your mortgage. You didn't pay it. Your tenants did.
Real estate will help me offset the income I make on stocks.
That's correct. A building that had a RiteAid lease valued at $4.5 million as an empty shell, $1.5 million, which just lost 66% of its value. The property that you bought for $360 is no longer worth.
This is the Cash Poor Asset Rich podcast. I'm Mickael.
I'm Amer.
We break down real estate in a way that's simple to understand,
Easy to relate to,
and practical enough to act on.
Let's get started.
All right. So let's talk about how a real estate deal actually works. Let's kind of go through what it takes, the components. So a lot of people think real estate just sounds complicated, just the name being thrown out. But is it really complicated? What does a deal even mean? Obviously, it's probably from a perspective, but to you, what does a deal mean? Like for me to, if I'm listening in for the first time, I'm making $300,000 a year. What is a deal? What does that look like?
Well, let's go ahead and start off from ground zero.
Okay.
Ground zero would be finding a piece of property, whether it's land, whether it is a home, a condo, an apartment, a medical office, a shopping center, or a mall. You acquire the asset by paying 100% cash for it. Costs $100,000.
Okay.
You cut $100,000 check. You get a title company involved to clear title and to ensure that you're provided title insurance where the property that you are buying is not encumbered by any other obligations out there. So you buy it, it's yours, you have the deed to the property, you paid $100,000 in cash, you own it, you got to pay the property taxes on it, you got to maintain it, pay the property insurance on it, and it could be vacant or it could be occupied where it's generating income from a tenant. Fundamentally, that's like ground zero of a real estate deal. However, most real estate deals are not purchased that way. Most real estate deals are purchased with a component of a down payment, which is the buyer's equity in the deal, and a loan, which we also call a senior debt. So the component of the capital stack, the capital stack is what it takes to buy a real estate deal, is divided into equity and debt. Equity is the money that you bring in. Debt is the money that you borrow to buy the asset.
And a lot of people think debt is automatically potentially a bad thing. Is it a bad thing, or is there multiple ways of looking at debt?
Debt can be a bad thing, but generally it's not. It could be a bad thing if you're buying a private property and you don't have the income to pay the mortgage payment on it. Then debt becomes bad. Debt becomes bad when you have a real estate deal that you bought with a promise of a tenant that's going to stay there for a long time, and the tenant goes into some hardship and you no longer have that tenant, then debt becomes a cumbersome conversation. Best example to that we've seen recently happen in the marketplace here is all the pharmacies that are closing down or going out of business. The RiteAids of the world. Those assets at one point were great assets to own. Great credit tenant, a pharmacy, very high in demand. Debt was no longer an obstacle because the pharmacy paid its rent. Out of the rent, you service the mortgage on the property, You serviced the property insurance, the taxes, the maintenance, and you took a good, healthy, positive cash flow home. However, the dynamic and the landscape of those tenants have changed over the years. Their demand in the marketplace and the product that they sell has no longer became viable to the consumer. It's not proprietary to them. Selling groceries and selling prescription drugs out of a pharmacy is nothing proprietary. Other merchants were easily able to duplicate it, whether it's the Walmart or the Amazons of the world, and it was far more convenient to the client. The customer that's walking into a pharmacy does not need to physically go to the pharmacy to buy their groceries or their prescription drugs. It comes directly to them. As a result of that, debt in that example for those property owners or investors that had a fair market share in assets that were occupied by pharmacies, debt has become a big burden to them. Because unlike residential real estate, in residential real estate, assets values are based on comparables in the area. You go into a neighborhood and there's 10 homes in that neighborhood that are selling for 500,000, and you have a home similar in bones and structure to those comparables that are selling for 500,000. By default, your house will be worth 500,000. Commercial real estate is a completely different animal. It does not work by comparables. Comparables play a factor in valuation. Area plays a factor in valuation. But mainly, commercial assets are heavily driven by their cash flow, and that's what determines their value. And we'll dive into that in further episodes down the road, which we call cap rates. Therefore, cash flow diminished strongly on the properties that were occupied by the RiteAids of the world. As a result of that, a building that had a RiteAid lease could potentially trade at or valued at $4.5 million. Now, as an empty shell, it's valued at $1.5 million. Well, it just lost 66% of its value. Well, that's a problem not only for the borrower, hence the investor, but it's also a problem to the lender, to the bank.
Sure.
Because now their collateral, what they're holding on to support the loan, does not have the value anymore. So in most instances, the loan value became greater than the real estate value. And then from the investor perspective, that's a problem because now they're servicing a debt on a property that's highly inflated in its value versus its current value today. This is a very good example of how debt can be a problem and a burden. But also debt can have a huge advantage to the investor. Now, with the right debt and the right cash flow from the property to support the debt, investors can get into deals that they just can't buy outright in cash. If someone has an aspiration of owning a retail shopping center, and that retail shopping center is $10 million, well, there's lenders out there that would give you 75% of the $10 million as debt, and you would have to come up with 25% to buy a $10 million shopping center. So if you bought it in cash, you would have to spend $10 million on it, which not too many people have that kind of money laying around.
And not only, I think, having the type of money sitting around and talking about that, I think it even diminishes the title of the real estate property being a deal. Because if you're not leveraging that, the deal looks worse, right? In the eyes of like the investment. Is that correct?
Depends.
Sure.
So there is positive leverage and there's negative leverage. Positive leverage is created when if the easiest way to explain it is if you have a property that's yielding an 8% annual return. So you invest $100,000, that's how much you bought the property, it's bringing you 8%. It's bringing you a total of $8,000 on your $100,000 investment. If you get a loan that's good enough an interest rate to be less than your annual return, let's say you borrow money at 5.5% or 6%,
Sure.
and the property is yielding an 8% return, because there is a spread between the cost of the loan versus what the property is yielding in an annual return, you could make more than an 8% return on your money. That is what positive leverage is.
Got it.
However, if the spread between the interest rate and between the annual yield of the property is very small, then what happens in those cases is interest will supersede the return, diminishing the return instead of increasing the return. So it's really a combination of what are you borrowing money for
Sure.
versus what is the annual yield of the property is what's going to determine whether it is a positive outcome or a negative outcome to
Okay.
the debt.
So to kind of go back on the first question in terms of like, real estate being complicated, what is a deal? What does that even mean? So basically, to kind of, summarize it, is just buying something, and in this case, it's a real estate property, and making money from it. That really is the kind of that sums it all at the end of the day. If I was explaining it to a fifth grader, you're buying something that you can make money from it, right?
100%.
Perfect. So let's break down a deal. What are the main pieces, and what are we actually buying? Give me an example, and let's keep that the example of me as a listener. I'm making $300,000 a year, and let's kind of break that down. And what does that deal look like? And what are we actually buying? Let's focus on a particular asset class. Is that cool?
Sure.
Okay.
Let's talk about something that's very easy for any listener to understand. Let's
Perfect.
talk about a shopping center.
Okay.
Very easy. A shopping center can be either a single tenant shopping center where one tenant occupies the entire space,
Okay.
or it could be a multi tenant shopping center where a shopping center is split up into suites and each tenant occupies their respective space. Each tenant has a lease that's tied to the space that they occupy. And if there are 5 tenants in the shopping center, most likely this will result into 5 different leases. So
Okay.
when you're buying a shopping center, you're buying rights to the deed of the property, which is land, as well as the dwelling, the building that sits on that property. You're buying the parking lot and the common spaces that are developed on the property. And also, you're really buying the leases that you're inheriting from buying the property. So you have rights to all of those leases, and that comes in the deal stack, which is
Okay.
very important for a cash generating asset. You don't want to just buy the shopping center and not inherit the leases that come with it. Then it's back to what we talked about. Commercial real estate is not valued based on comparables and price per square foot. It's valued based on net operating income, what that property generates in net operating income.
Okay. That's fair. So just to keep it simple, let's say we found a particular, asset class, and it's a shopping center with, let's call it 3 tenants. And for some reason, we're able to find this amazing deal because we want to go with that $90,000 mindset, right? So if we take 90,000 and then we divide it by 25%, because you said 7, that's what you would have to come up with. We're talking about a $360,000 purchase price. Because if we took 360,000 times by 25%, we're going to get that 90,000 we keep kind of mentioning back and forth as an example. And these guys, this is literally just for number sakes. This is a dummy deal. This is just to kind of understand what a deal could potentially look like. So Amer, let's say we found a property, has 3 tenants, purchase price let's say our buying power is around 360,000, considering that bank is going to be okay with us purchasing something and just putting down 25%, which is the 90,000 that we have.
So you 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 find this property. It's got 3 tenants in it. Purchase price is $360,000. You
Okay.
find a good lender that would lend you 75% of the purchase price. You would get a loan for
270,000.
270,000 and you
Mm-hmm.
come up with a $90,000 down payment. Fundamentally, that's what it is. You know,
Okay.
there's other costs involved in a transaction, but we're not going to touch on those in this episode. We're just going to say
Absolutely. Yeah.
bulk, bare bone deal, 75% loan to value,
Mm-hmm.
25% equity, which what compromises our capital stack. Our
Sure.
capital stack is divided into those two sections. 25% equity, 75% is debt.
Okay. So now that we have that like laid out, now let's talk about what makes that purchase an actual deal, right? This is just, now we're just purchasing a property. How does it turn from a property into a deal that we're buying that makes sense in what we're doing, right? How does that work? Break it down based on this. What would you consider a deal, in this case? How would it look?
What I would say is transforming the purchase habit from just buying a property to a buying a deal is there's got to be a business plan in mind.
Okay.
What am I going to do after I close on this property? What is my business plan? Business plan starts with some very fundamental components is who is going to manage this property post sale? I have 3
Okay.
tenants in it. Who's going to manage those 3 tenants? Am I going to be the owner operator that's going to manage those 3 tenants? Or am I going to hire a property management to manage those 3 tenants?
And all these things are adding cost potential. Like if another entity is managing my property, I'm paying them to manage it. Obviously, they're not going to do it for free. So that's gonna weigh into, like you said, the business plan to make sure the numbers are fitting. Correct?
Yep, it's all factored into what we call our underwriting.
Okay.
Underwriting the deal is really creating a financial pro forma of how that deal is going to behave and how is it going to perform during the course of ownership. So if
Okay.
my business plan is to hold this property for 5 years, I should do a financial pro forma for the next 5 years and make assumptions on what it's going to cost me in property management. What is it going to cost me if I lose one of those 3 tenants over the next 5 years? And how much does it cost to replace that tenant? Do I have any capital improvements, any major repairs that I have to invest into the shopping center to keep the property looking good and to keep my tenants happy over the next 5 years? And what is my selling assumptions? How much am I going to sell the center for in 5 years? Am I going to pay any leasing commissions to sell it? Am I going to pay any closing costs to sell it? And what is my profit? So having a business plan, having sound underwriting, knowing when your entry point is and when is your exit is what makes a purchase transform into a deal. At least
Okay.
that's my perspective on things.
Yeah, no, absolutely. Can you give me an example of, so we've identified a property, we've identified the price, right? What is a hypothetical scenario for this property, for the price that we're purchasing, and the plan and the exit to make this a quote unquote, from our perspective, from your perspective, a deal, or even from the listeners, so that they can understand how does a deal look. So that way I want to know how far is that 90,000 going to stretch and what potentially could have an impact on the picture that's painted for it to be an actual deal. Again, this is hypothetical, but just so we understand how that works.
So you've identified that property.
Yes.
You have interest in purchasing that property. You start out with step number one is to put together a letter of intent and send that letter of intent to either the seller directly, if you're working directly with the seller, or the seller representative, which happens to be the broker. The letter of intent, think of it as a skeleton to or a guide for the purchase agreement. It really highlights the high-level bullet points of what's going to happen during the purchase agreement until that property is sold to the buyer.
Okay.
The price, key terms of the transaction, the due diligence period, the down payment, the closing period, the escrow agent that you would like to use to represent both sides.
Is this before you have any information about the property, or this is just like immediately after you see the property? So obviously we've identified the property and the price. How do you know what to offer them on that letter of intent?
So an underwriting needs to be done prior to typing up a letter of intent. And
Got it.
generally speaking, at that phase, you're strictly relying on the information that's being provided by the seller. So how
Sure.
did the property perform
Absolutely.
over the
Okay.
last 12 months or over the last 24 months? Maybe you've done a drive-by. Maybe you've done a very soft inspection. Looked at roof, looked at parking lot, looked at HVAC equipment. You haven't done a full inspection report, just very, very basic information based on seller feedback, which you are going to verify during the due diligence period. But you're strictly just taking seller financial, seller word, and providing a letter of intent. And we got to keep in mind, most, if not all letter of intents are all non-binding. So it is a
Okay.
non-binding document.
And at this point, when you're doing a little bit of your underwriting before you send the letter of intent, are you like kind of going back, like what makes it a deal? Are you looking for it to be underperforming, somebody that is underperforming and you can improve it potentially? Or it's somebody that's, a landlord tired, they just want to get rid of it? Are you looking for a fixed, like something that's already fixed, like know that all of the tenants are there and you know how much you can bring in? Like what is it that you're looking for you to be sniffing a potentially good deal?
It goes back to your business plan, Michael.
Okay.
What is your business plan? Is your business plan to buy a handoff that's polished, that's ready to go? You start generating returns from day one, conservative returns because it's what we call a stabilized asset.
Okay.
Or is your business plan that you want the deal out there that has the most amount of hair on it, and you want to roll up your sleeves and you believe that this is an undervalued asset because of its past performance and you have a business plan to improve it, and then you're looking to either sell it or keep it after you improve it, that is all part of the business plan. So the business plan needs to be identified.
Got it.
At least on your side before you engage into a letter of intent, because the business plan is really going to dictate what you're willing to pay for the property. The seller may have a price in mind, but that doesn't necessarily align with your business plan. So identify your business plan, complete your underwriting, provide a letter of intent. Once the letter of intent is reviewed by the sellers or the seller's agent, there will be some back and forth communication about the letter of intent. And then eventually both sides will reach an agreement that this is the skeleton, this is the foundation of our transaction. And then once that letter of intent is signed, typically a purchase agreement is drafted by either side. So if the seller side drafts the purchase agreement, the buyer side comments on the purchase agreement. And the purchase agreement is a document just stating how the purchase is going to go and what everyone's party that's involved in the purchase or the sale, what their rights are and how the transaction is going to make it to the finish line.
Okay. And the letter of intent, is that pretty much you raising your hand and saying, I'm interested in your property?
That's all it is. It's non-binding.
Got it.
There's really no money that you put down in escrow with a letter of intent. It is just raising your hand and saying, "Hey, I am serious, and I want to pursue this purchase further."
Okay. Understood. So let's just for us to kind of understand this on the listener side and everything else. So let's say in this case, the business plan is to buy an underperforming property and the goal is to improve it. And what I mean by that is kind of going by the example of buying this 3-tenant plaza for $360,000. And my down payment is $90,000. And then when I'm buying it, I'm buying it with 2/3 of the space being occupied, and which now we're talking 33% potential underperforming or improvement. Maybe the rent is not there. Maybe you can improve the space. I don't know. I'm just kind of whatever it is going to take to improve that asset. Now, and then maybe we can call it a 5-year exit plan, right? So that is my business plan. I'm buying something that we have identified. We understand the price so far. We want to buy it as underperforming so we can add value, right? And in this case, I want to move into how the money flows. So $90,000 I have invested. Walk me through the money step by step. Like, where does the money come from first? I'm putting in $90,000. And what happens to that money? Like, walk me through that. What do I need to do based on the business plan I just provided you?
Great. So let me just identify to our listeners the difference between the first scenario we talked about and the second scenario, just so we're all on the same page.
Yeah, perfect.
It's the same plaza. Scenario number one, we're buying it. All the 3 suites are fully occupied by a tenant. Scenario number 2 right now that we're moving to is 2 out of the 3 spaces are occupied by a tenant, and we have 1 vacant space.
Yes, perfect.
So what we've discussed in the past, recently, is the value of commercial real estate is based on net operating income / geography / area, not only based on comparables. So logically speaking, if that same plaza is only occupied by 2 versus 3 tenants, and as a fully leased up shopping center, it's $360,000 purchase price, then if it's occupied by 2 tenants, it's going to be less. Or you would want to buy it for less. The reason why you want to buy it for less is because there's going to be cost involved to be able to backfill that last suite. You are going to be most likely providing some sort of a tenant improvement allowance for the 3rd tenant to be enticed to come into your space. The 3rd tenant is going to be brought to you by a broker, unless you represent yourself. But generally speaking, you want a commercial broker representing the space. They're going to have to earn a leasing commission to be able to fill up and to go to work and find you a potential tenant that would go into that 3rd space.
So I'm going to throw something in here. I'll say, so the purchase price is still the same.
Okay.
Let's call it $360,000 because we want to back it into the $90,000 investment.
Yeah.
But with still 2/3 of it being occupied, the NOI, net operating income, before mortgage comes out, everything else is out before mortgage, just so people understand, is $36,000, which puts it at and you can maybe go into that more, puts it at a 10% cap rate at the purchase. And cap rate is capital. Maybe you can go into further details on what a cap rate really means.
The easiest way to explain a cap rate is the return on your money in the event a property is paid for 100% in cash. So if a property is 360,000 and it's generating a net operating income of $36,000, that's 10% of the purchase price, then this property or this deal is considered a 10 cap deal. It's yielding a 10% return on capital.
So that means I'm not putting 90,000 because I'm not utilizing banks at this point. I'm putting in the full 360,000 out of my pocket, buying it in cash, and the return on that, because we're at a 10% capitalization rate, it will give me $36,000 per year.
That's exactly right.
And that's profit for me because at this point I don't have a mortgage. I paid it in full.
That's exactly right. There's no debt on the property to service whatsoever. So you're yielding 100% of the net operating income as a return.
Beautiful. Okay. So now that we know that, now we understand what capitalization rate is. I want to be able to leverage, and if it's possible, to see if the deal is even leverageable, right? I don't even know if that's a word, but can we leverage this deal with debt?
Yeah.
And how does that look?
Yeah. So instead of putting up the entire purchase price of 360 grand,
Mm-hmm.
and you find a bank that would give you 270, which is 75% of the real estate value, now you're only coming up with $90,000 instead of coming up with 360.
Okay.
That's the power of debt, right? It gets you into a deal that you may not be able to buy without the bank's help. And now that you have a bank involved and interested in doing the transaction with you, you can get into this deal with less money out of pocket, less equity.
Okay. And how much? So 370,000 I'm borrowing from the bank. The bank is here's 370,000. First and foremost, do I need to show experience? Will the bank be like, "Oh my gosh, we've been waiting for you to come to us for us to lend you $270,000. Who on earth are you?" Like, or are they going to be like, "Wait, do you have experience? Do you need experience?"
No doubt. Every bank is going to look at who the sponsor is. And
Okay.
the lack of experience in real estate can easily be mitigated by doing a joint venture with an experienced sponsor.
Okay.
So, Michael, you're an experienced sponsor. You've done real estate transactions. I am brand new to the game,
Okay.
but I want to buy real estate. I may not have a strong balance sheet to show the bank that I am financially stable, but I found this really cool deal and I want to buy it. What I can do is I can bring in a sponsor to vouch for me. Really, that's what it is. You know, that sponsor is vouching for you, and that sponsor has the track record, has a healthy balance sheet, has great credit, has good relationships with lenders that they've worked with in the past. So bringing in a sponsor would definitely solve your dilemma. You may have the experience because you've been in the market talking to brokers and talking to sellers, but you haven't really done a transaction yet. Then doing a joint venture with another sponsor will definitely get you where you need to be.
So is that the only way? If I wanted to do this on my own, $90,000, I got it in the bank. I want to invest it. I have to find a joint venture. Otherwise, no bank is going to look at me. Or are there other ways to do this?
There are other ways to do it. There are banks that, yeah, they do look at the sponsor. They want to look at who is behind the transaction. But the way they do their internal underwriting is not specific to the sponsor or the guarantor. It's more specific to the property itself and the cash flow of the property. Life insurance companies typically do that. Mortgage-backed securities are set up that way. So there are products out there in the marketplace that do look at the guarantor, do look at the real estate experience to ensure that the guarantor can potentially execute this business plan, but their underwriting is not individualized to that guarantor. Their underwriting is more focused on the cash flow of the property. Can that property service the debt before the
Yeah.
guarantor? Other
Gotcha.
banks will say, well, can the guarantor service the debt before the property? Your Bank of Americas, your Comerica's, your Chase, those guys are going to look at the guarantor first and foremost before the property. Does
Yeah.
the guarantor have enough outside income to service the loan in the event this property goes bad? Other lenders will look at the property first before the guarantor.
Okay. I obviously we can do a whole episode about this, and another thing that came to mind is potentially, there's a keyword that's been thrown out now more than ever is creative financing, whether it's seller financing and stuff, and that makes it a little bit potentially. I don't know if it's more complicated, but I'm sure they're harder to find. But we'll segue into that at other episodes, but without going into a rabbit hole here, I want to go back to, so I'm lending $270,000 from the bank. Okay. How much is my mortgage? Is it I'm buying a house today. I can get a mortgage for 30 years amortized. How does that work in the commercial? Is it different? And what is the cost? How much is it going to cost me per year to pay that mortgage for the $270,000?
Sure. We're gonna need a mortgage calculator to talk about that. But I think what's important here and what you want to get to is there an advantage in leveraging debt to increase returns? Right.
Correct.
That's what we want to get
Yes.
to. Can I use
Absolutely.
Can I use less money and
Mhm.
increase my returns?
Yes.
So scenario number one, $360,000 property. I paid for it fully in cash. It's generating $36,000 a year. I'm making 10% on my money. Nice and clean.
Yes. Very clean.
Now, how about this scenario?
But I don't want to do that. I'm greedy. I'm greedy. I want to potentially make more money than the 10%.
And it's possible as long as you structure the right debt. So we'll take that same scenario and use bank
Okay.
money right now. We're using $270,000 of bank money, and I'm
Okay.
using $90,000 of my own money instead of $360,000.
Okay.
My net operating income on the property doesn't change. It's still $36,000.
Sure.
But what the added component would be having a mortgage payment to pay.
Mortgage. Yes. Okay.
And let's assume that mortgage payment happens to be, I don't know, $24,000 a year.
Okay.
Okay.
Sure.
So now I'm no longer left with 36,000. I'm left with 12, because 36,000 is my net operating income minus $24,000 is my mortgage payment. I'm left with
Okay.
$12,000 a year. Now, where it could be confusing to some new investors as well, I am making $12,000 right now on my 90,000,
Yes.
generating a 13.5% return.
Almost 13. Yeah. 13.5%. Yes.
Okay.
So the difference between, the first example was $370,000 investment. I put in all the cash.
360.
Oh, was it 360? Sorry. Yeah. $360,000 investment. And I'm getting a return on my investment of 10%, which is making me $36,000 a year. Okay. Versus now I'm leveraging the bank. I'm bringing a bank. I'm putting 90,000 instead of the $360,000. And now I am making 12,000 a year, even though that's obviously less than 36, but I put a lot less money than what I initially was going to put buying the deal in full. So now I put 90,000 and I'm making $12,000, translating this into 10% versus now I'm going to be making 13.33% if you want to do the perfect math, but let's call it 13.5% return on your investment. It's a big common word that ROI. Maybe people know it as ROI, return on investment. It's what you invest and what you're getting in return. So in this case, it's 10% previously paying it in full versus 13.5% utilizing debt.
And using less money and getting into the
Yes.
same property. And if the business plan goes well, your tenants are paying your mortgage. You're not paying your mortgage. Your tenants are paying your mortgage that are occupying the space. You're paying down debt over time, and the property is appreciating in value over time because just the way things work. Year over year, inflation kicks in, real estate is going to appreciate, and so is the eggs that you're buying at the supermarket.
And another thing is, let's say that I just realized, maybe I'm wrong, but your dollar gets stretched beyond not just making a better ROI, but if you made, so what is here? Let me do this. 360,000 divided by $90,000, that gives me 4. So I can take 90,000 and invest it in 4 similar properties, and as you had said before, is the appreciation game too, and have all of them appreciate instead of just one of them appreciate. If I had to put all my money in there, having one appreciate, doesn't that give me a lot more leverage as well on top of that?
And you're more diversified. Now, we always go back to the old
Very
saying,
true.
don't put all of your eggs in one basket. Now you're
Yes.
diversified across 4 properties instead of one. If one of them underperforms, it's not all 4 that are underperforming. So you are shielding yourself from the unknown. So
Yeah.
I want to take what we're talked about right now and tie in so we could wrap up this episode is what makes a deal. What makes a deal is not a purchase of real estate. Purchase of real estate without having a business plan can be a burden.
Hmm.
What makes a deal is knowing how to enter, how to execute the business plan over the course of ownership, and how to exit if the plan is to exit this property, whether it's a 5-year plan or a 10-year plan, but having a very, very clear trajectory of what you're going to do with the purchase. A similar analogy I can give to that is you can go buy a car today, but if you don't
Yeah.
need that car and you're not driving it, then that car becomes a burden on you. It is the same with real estate. When you buy real estate, you got to know where your trajectory is. You got to execute your business plan, and then you got to move on. You buy it
Otherwise,
without a
you're just
business
doing it to
plan,
do it.
you're just doing it to do it, and it's going to become a burden on you.
Yeah.
So I hope that clarifies what a deal is versus what a purchase is.
That is great. And then, okay. So, and this whole time we've been talking, the only thing that we have truly covered is only one aspect from the 4. Is that correct? Only one thing out of the 4 things that have we covered, which is the cash flow portion.
That's correct.
Wow. That's insane.
And
That is
just to
insane.
remind everyone, the 4 pillars of real estate is appreciation over time, depreciation for a tax write-off, cash flow, and mortgage pay down by your tenants. 4 different avenues of income versus one with some other investments that are comparable to real estate.
That's amazing. So what I actually want to do, I will just continue this episode, and maybe it will be split into 2. But so let's continue, because I don't want to close it off without having to talk about all the other things. Since we talked about cash flow, let's talk about the other 3. So when you say the tax side, or the depreciation, can we go into that? And then we're going to go point by point in the Fantastic 4 that you just explained.
Depreciation is simple. Here, our government in the United States rewards you for buying real estate. And the reward comes in bonus accelerated depreciation the first year of purchase. Commercial real estate, is usually is depreciated over a 39-year period according to the tax code. However, we can shorten that 39 period tremendously by taking a big portion of that 39 period in year one. Today, for tax year 2025, any purchases that were made in 2025, any bonus or accelerated depreciation that the investor have taken, they were able to take 100% of that money year one.
Wow.
And how
So
does
explain that to me. Yeah, how does that work?
how does that work? Is just like any
In our example.
business that you own, you get a K1 at the end of the year, which is usually your earnings as a member or a shareholder of that business. In real estate, it's the same. When you take an accelerated write-off, the first year of ownership, you are going to receive a negative K1 instead of a positive K1. A negative K1 that would flow into your personal tax return as a write-off for any passive income that you have outside of this transaction. Any passive income. We got to be very, very careful with that word. Any passive income. And what defines a passive income
Very true.
is income that you don't have to work in your profession day in and day out to do. So, example, if I am a doctor and I am seeing patients and I'm getting compensated for seeing those patients, that's not considered passive income. That's active income. And real estate depreciation cannot write that off. However, let's say you have a real estate portfolio and you cashed out some positions that you've had. You've bought Ford Motor Company 10 years ago. You've made $500,000 on Ford Motor Company because the stock has appreciated in value and you sold those positions and now you have a gain of $500,000. What you can do is if you have a $500,000 write-off from a real estate purchase, you can write that gain that you've gained on Ford Motor Company completely, where your gain is zero. And all you had to do is just buy a real estate purchase on the day that or on the calendar year that you've realized that gain from the stock market.
So wait, are you saying that I could potentially invest some of my earnings in stocks and then real estate will help me offset the income I make on stocks?
That's correct.
Okay. And most of the listeners probably are on the active side versus the passive because
that's what I wanted to make that differentiation. Are you a daily trader? Is that what you do day in and day out? Is you're a stock trader?
yeah,
Real estate will not help you in that case. But if let's assume that you
got
have
it.
a third party portfolio with a third party manager and you've received a gain on money that you're not managing yourself. This is money that's being managed by a third party. You're in a passive position, then real estate will help you offset those gains.
Got it. Okay. Understood.
Similarly, if you have other real estate investments and you didn't know about bonus depreciation, you can offset some of the income that you have from other real estate investment with depreciation of future purchases.
Okay, so run me through a scenario on the example. We purchased that $360,000 property, regardless, option A or B. Let's go with B because that's ideal, right?
Yeah.
And I make 300,000, and on our first episode we had talked about that 300,000. A third of it goes to Uncle Sam, IRS. So $100,000 will go to IRS. How does this help me from not paying the $100,000 to IRS from the $300,000 that I made?
Well, if it's a W-2 $100,000, it's not going to help you much.
Got it. Okay.
It's not going to help you much. However,
okay.
Let's stay in that passive realm because that's what we're talking about is that passive realm.
Yes.
Let's say out of the $300,000, 100,000 of it came from a passive stock investment. Okay.
Okay. Sure.
And that $100,000, you're at a 35% tax bracket. You're about to give 35 grand away to Uncle Sam because of the gain.
Got it. Okay.
And we're dealing with the real estate purchase valued at 360 grand. Over the last
Yes.
few years, every bonus depreciation that I've seen on all the real estate transactions that I've been involved with, we were able to capture over 30% of the purchase price in depreciation. So for easy
Okay. So in
numbers,
this
let's say that
case,
number is $120,000.
okay.
And I know that my gain on this $100,000 income that I've made from stocks is going to be $35,000, and I have $120,000 coming from real estate depreciation because I'm going to get about a third of what I invested, which was 360 grand for a purchase price. Doesn't go by the down payment that you've made. I want to make that very clear. It goes by the actual purchase price. Okay.
Which
How
is
much you,
great,
how
which is
much you,
amazing.
which is amazing because you're getting more than dollar for dollar in some cases in depreciation
Yes.
versus money invested. So I'm going
Okay.
to get $120,000 write off, and I owe 35 grand in gains on the stock investment. Well, I just wiped off that entire 35 grand, and I still have $85,000 remaining that's going to roll over to the following year of unused depreciation that I can use in future tax years. That's how cool this is. So I just
That's
made,
incredible.
I just bought myself a cash flowing asset. I got a write off for almost dollar for dollar of what I've put in as a down payment. I've shielded my taxes that I was about to pay on my stock investment, and I'm paying $0 in gains because I have the write off to overcome it. So the
Okay.
end result is I have a new asset that's going to cash flow. I wiped out the gain that I was about to pay on the stock investment side. I have rollover depreciation that I can use in future years, which is 85 grand in this example, that's untouched. I'm going to make a return on my down payment from the tenants paying me rent. I'm going to pay down my mortgage because the tenants are paying my mortgage. I'm not the one that's paying it. And my real estate value is going to appreciate over time.
So wait, so the hundred,
I've solved 5 issues here. 5 issues
yeah,
in one move.
that's amazing. So let me understand and clarify this. So the 120,000 in depreciation that I'm receiving, does that go off of the 100,000 that I made in stocks, or does that go off of the $35,000 in what I owe the IRS? Is that credit? $120,000 in credit?
No, it's income. So if you made
Okay.
if you made 100 grand in income,
Yes.
your tax obligation on 100 grand is 35 grand. Okay? But what the real estate depreciation is going to do is going to offset that income. So income, and I probably restated this incorrectly on now that you're touching base on it. If you have $100,000 of income on the stock side and you have
Yes.
$120,000 depreciation on the real estate side, what your carryover would be is an additional $20,000 for future years. So it is not a
Gotcha.
credit; it's
Okay.
a write-off of income. And I misspoke earlier, but you are.
No,
Thank you
it's okay.
for catching that.
Yeah, of course. I just want to understand so we're all on the same page. So I'm making $300,000 out of that is I made it in stocks. Not as a day trader because obviously I have a full-time job, but as an investment. So that $100,000, because of the property I purchased, pretty much the net of that helped me save $35,000 for that year back in my pocket. So instead of me writing a check to IRS for $35,000, it helped me save that and be able to now take that 35,000 and invest it potentially in real estate, and back to like your lifestyle and what you want to do with that 35,000. But that was money that you were literally going to give to IRS.
That's exactly right.
Gone, literally gone. And you can take that 35,000 and put it in the S&P 500 again, and over the 40 years, and you can do the math on your own and see how incredible that is, and how compounding of that will work. But that is amazing. On top of that, and the same scenario, you still have 20,000 in depreciation, not 20,000 taken off your taxes next year, but the following year to depreciate 20,000 from let's say you made $100,000 again the year 2 and you invested $0 in real estate. Now, instead of paying 100,000, instead of paying taxes for 100,000, you're paying for only 80,000 of it. Is that correct?
Very clear. That's exactly right.
Guys, this is crazy. It's really is, you know, these are the aha moments that like really like paints the picture on how amazing real estate is. And it's always a debate. I'm always like, is it stocks or is it real estate? And if you have all these amazing benefits of real estate, I mean, obviously there are ups and downs, but wow. Okay, so now we covered that. That is as clear as glass. And that thing, the forced appreciation, what is that called? What is that?
Value increase over time.
Okay, got it.
And
Okay.
in commercial real estate, the way it really happens is if leases were written correctly, most leases will have escalations in them.
Okay.
Today, you're paying $15 a foot. Next year, you're going to pay $15.50 a square foot. Typically, those escalations are ranging anywhere between 2 to 3% per year, if leases were structured correctly by whoever written them. Escalations are going to drive net operating income. As these escalations hit, net operating income is going to increase with time. As net operating income is increasing with time, so is the value, because we talked earlier that the value of commercial real estate is not based on comparables, unlike residential, based on income.
Yeah.
The more income you're going to drive from the subject property, the higher the value is.
And this kind of goes into the appreciation side of it. But before we get into the appreciation, let's talk about, you had said you have the tenants pretty much paying your mortgage, right? What does that do? Obviously, this is one of the fantastic four that we've been talking about. But what does that do in terms of, explain it in a way, maybe like if you own the house, like you own a house, you're paying down the mortgage. What is that doing?
It's as simple as you outlined it, Michael. You buy a $500,000 house and you take out a $400,000 mortgage on it.
Yes.
After 10 years, you sell that house for $500,000. Let's say it did not appreciate $1. You sell that house for $500,000. However, over the course of the last 10 years, you've been paying down that mortgage. That mortgage balance is no longer $400. It could be $350, it could be $325, but for the example of our conversations, let's say it's $300,000. Now, the house hasn't appreciated in value, which is unrealistic, but for simplicity of example, let's say it's $500,000 still the value of the house. When you go pay out that mortgage and you sell that house for $500,000 and your mortgage balance is only $300,000, you're going to take $200,000 home. However, if the mortgage has not been paid down, you would only take $100,000.
Yeah.
But when you have somebody else paying your mortgage for you, the extra $100,000 that you're taking after 10 years of ownership, that's pure income.
Yeah.
You didn't pay it. Your tenants did.
Absolutely.
So
And you were cash flowing in the meantime.
And you were cash flowing in the meantime.
Wow. And I mean, that's crazy. So is it fair to say that the percentage, your percentage of ownership, because you're getting a loan. So we talked about 75-25. You technically only own 25% of this property. The bank owns the rest of the 75 in the papers until it's paid off, because you owe that person the 75%, that bank.
The bank
So
is your
that
partner.
percentage, the partner, exactly. So that percentage, after, like you said, an example of 10 years, instead of it being 25%, we call it equity. You own maybe what, like 40%?
Yeah, your equity position is increasing because you're paying down your debt.
Wow.
So you're earning
Okay. All right.
earning
So,
sweat equity for executing your business plan.
wow. That's amazing. So your percentage goes up, you're earning equity, and then when you go to sell it, it's money that your tenants have been paying. I know the example that we used on the house is just to kind of make it understandable, but the house scenario is a worse example because you own it. It's more of a, even though it's considered potentially an asset, it's more of a liability because it's coming out of your pocket. It's not income producing, even though
That's
there's
right.
value into it after you sell it. So now let's move into the appreciation side. How can I look at, kind of maybe an example of the house as well of an example, and then segue into the example of the $360,000 purchase of this real estate property and the improvements we've made at this point.
So a house is going to continue coming up in value as the neighborhood rises in value, and it's strictly an inflation type scenario where cost of living is increasing, cost of new construction is on the rise, therefore cost of existing inventory needs to just follow suit.
Yeah.
However, with commercial real estate, the appreciation is mainly driven by the escalation of the rents. What a tenant is paying per square foot today is going to be higher 3, 4, 5 years from now because there's 2% escalations clause in those leases. However, at some point, the market is going to come to a cap, and we call it the market reset because there's just no longer room for appreciation in that market. And it could be several reasons. It could be geopolitical issues. It could be population growth. It could be the presence of an abundance of inventory. Some of those scenarios can reset a market from continually increasing to infinity. But generally speaking, there's cost escalation clause almost in every lease, in every commercial lease. A commercial lease can be 3-year, 5-year, or 10 years. The way I like to structure our leases is I like to see a 2% escalation year over year. So a lease that was executed in 2026, in 2036 should be 20% higher than what it was in 2026.
Okay. So in this case, just as an example to our $360,000, let's say each of those tenants pay $18,000 in rent per year. So if you have two of them, which is in this case, it's the adding, like buying something that we talked and improving it, whether it's, bringing in someone to rent it or whatever, increasing rent, expenses going down. And you had mentioned that the income is what drives, which is the rent, you said. So your NOI, your net operating income, is what drives the value of that property, which we touched based on earlier. So in this case, let's take 18,000 and times it by 3. So now we went from $36,000 in NOI to $54,000 in NOI. And we did that within 3 months, 6 months. How does that, how does that help appreciation?
This is not a normal escalation as we discussed earlier. This is
Yes, sure.
value creation is what we're kind of
Yes,
segueing into.
exactly.
A normal escalation would be as mentioned, 2% year over year.
Sure.
However,
That's if it's a fixed asset, like you're saying.
if it's a stabilized fixed asset. What we're
Understood.
discussing right now is value creation, is increasing the value
Yes.
of the property because the income didn't just increase based on a regular escalation schedule. The income increases because we've increased the occupancy, the physical occupancy of the property, driving an
Okay.
additional $18,000 in rent. Not only that you're driving $18,000 in rent, but also now you're spreading the expenses of the shopping center across 3 tenants versus 2 tenants. So you are no longer responsible for the pro rata portion of the expenses tied to that vacant space. The tenant is now paying it. So the increase is
Yes.
not only $18,000. If you look at the cash flow, the increase is more than $18,000 because you're no longer covering the expenses of that vacant suite. I'm going to
Interesting.
assume I'm just going to give those expenses a face value of $6,000 a year for the vacant suite, which call it the insurance, the property taxes, and the common area maintenance, also called triple
Okay.
nets, NNN.
Sure.
We're going to be talking a lot about NNN properties versus gross lease properties in future episodes. But let's say
Okay.
that gain
Yeah.
is 2 components. It's $18,000 in additional rental income plus a $6,000 in expense recovery that the landlord is no longer contributing to the vacant space. So that's $24,000.
Yeah.
Okay?
Okay. So we're taking 36,000 plus the additional value add of $24,000.
That's
We're
exactly
at
right.
$60,000.
No. We're talking 18,000. You said you wanted to lease out each vacant suite for 18 grand a year. So it's
Yeah.
18 plus 6, which is the expense recovery. That gives us a total of $24,000.
But
Assuming
we're making, this is the additional. I got you. I see what you're saying.
um,
I was just saying 60,000 total, but yes, I got you.
the additional. So the additional $24,000 a year, and we've been talking about 10% returns since the beginning of the episode.
Yes.
That automatically translates to an additional $240,000 in value creation.
Wow.
So now the property that you bought for 360 is no longer worth 360. It's worth 360,000 plus an additional 240 for the value creation. That's an immediate
Which
upside.
This puts the property at 360,000 plus 240,000. That's $600,000. So the property almost doubled.
Almost doubled in value.
Wow.
You don't see
And
that
that can happen.
that
doesn't happen years. Yeah.
and that doesn't happen in residential real estate at all. So, our listeners
No.
out there that are flipping single family homes, it doesn't happen because you're valued based on comparables and you're not valued based on income.
Yeah. I think a lot of people, I don't want to call it a mistake. Obviously, getting into real estate is getting into real estate at the end of the day. You don't want to do it just to do it. But between commercial and residential, there's a big gap between 39 years that we talked about, 39 and a half versus 27 and a half in the residential side. And now also the potential of force appreciation in terms of what you can do, because if you're buying a value add potential property, you can do that in I mean, Amer, correct me if I'm wrong. I mean, you can do that in a couple of months or 6 months or even a year.
Yep. On the other side, the argument for those that are flipping single family homes is, well, I can buy an undervalued asset, a single family home, fix it up, and sell it at market, and make a good upside in a short period of time. But then buying it, you just have to buy it right at that point. You have to find that deal. You have to find that diamond in the dirt that is undervalued, that is ready for a fixer-upper, a business plan. Put it back on the market after you fix it, you flip it, and you make your margins. Here, with commercial real estate, you're driving value strictly by backfilling existing spaces that you have, that you've bought with the asset already, that you've inherited with the asset. You're just trying to find a tenant to occupy.
So it's all in the commercial side, it's about improving the NOI, whether it's lowering expenses or increasing income.
That's right.
That's amazing. That is amazing. Okay. Well, I think that really, paints the picture on what a deal could potentially look like. I hope it's been it's been easy to understand. Real estate can be a little bit, and you'll see some of the episodes we'll be doing. It gets it gets really down to like, it's going to be hard to understand, but our job is to be able to make it understandable. So that way it's something that you can easily digest, and not only easily digest, you'll be able to take action on. And that's it. This is all we're doing here is providing knowledge at a level of, hopefully, that it's something that's perceived from your end is easier to understand than what you're used to.
That's exactly right. And we'll be diving into more layers in our upcoming episode. Stay tuned for episode 3. Mickael, if you want to just kind of highlight and give a very, very little sneak peek of what we're going to be diving into in episode 3.
Okay. So on episode 3, what we're going to be talking about is the biggest mistakes high earners make when investing. So make sure you tune in to be able to understand so you don't make mistakes. And obviously mistakes can be good because you'll learn from them and build wisdom, but why not utilize other people's mistakes to create your own wisdom and save you time? So make sure you tune in. If you got value from this, do something with it.
Subscribe,
Ask better questions,
and stay consistent.
because building assets isn't about one big decision.
It's about disciplined and calculated ones over time.
If you know someone who earns well but isn't building assets the right way,
Share this with them.
this is the Cash Poor Asset Rich podcast. I'm Mickael.
This is Amer. See you next time.